everybody. Welcome to Friday, another Talk Money with Tom show. We want to try to help you increase your chances of having more successful financial retirement. We do that by answering your questions. Send them in. Even as we're going here, we'd love to try to answer them live. Obviously, you can send them during the week. There's an email address here, asktom@talkmoneywithtom.com. You can put them into the chat box, whatever you'd like. We'd like to try to help you with the questions that you might have, specifically around asset management, retirement planning, and tax planning. Those are the three big areas that we tend to cover. And of course, we are huge believers that education is a key component to having a more successful financial retirement. It's why we do this show. It's why we have this channel. So you can subscribe to the channel and hit the little bell button there to get notified when we put new content on. We already have over 1,000 videos on the channel. You can go through and look at some of those and see if you can pick up something that might help you too. And of course, we're always available for an appointment. You can meet with Ethan and I, on a one-on-one basis, kind of a phone or video, 30-minute appointment to just basically, answer your specific questions that you might have for yourself. So look forward to being able to do that. One quick reminder is that we're not going to be here next week. We will be on vacation, so there won't be any daily videos, market updates as far as that goes. And of course, we won't be doing a show, but we'll be back the week after that. And so looking forward to today's show. Hopefully we can find something that, really, catches your attention and that you can use to kind of help yourself to improve your overall situation. I, of course, do like to start off the show with a summary of kind of what I saw happening in the market this week. This, of course, is the year-to-date chart that we always look at here for the S&P 500. You can see kind of the ups and downs that have happened. That blue line is the 200-day moving average. And I've drawn a red line across a couple of the, high points for the year. We can see that that's down, obviously, as far as this goes. So some very significant things have happened this week, just in the sense that we've been retesting these low points, and we got all the way down, to the 50% retracement level. So if you go to the bottom of 2020 to the top, which is this year, and then look at how far down it's come, it's retraced about half of that gain, and there was a lot of buying that came in right at that point. So we've been holding up pretty well. There's a couple of things that are really driving the market upward right now. Number one, this is what they call earnings season. So we got all these companies reporting earnings. We've had 101 companies of the S&P 500 report so far, for example. And according to Bloomberg, since 2013, the S&P 500 goes up 76% of the time during earnings season. So really important category as a whole. Next week is the big week. And that's when we get the Apples and the Googles, Microsofts, and et cetera. So it's the big tech week. And oftentimes that's actually been a pretty good week for the market. These are great companies, and we'll see what happens. What we have seen so far in terms of earnings is that 73% of the companies have beat their expectations, which is actually pretty good. The average is 77%, so kind of in that same neighborhood. And the one big difference is that they haven't beat it by very much. So on average, the companies beat their expectations by 8.7% on their earnings growth. This quarter, it's been 0.1%. And these, of course, expectations have been lowered some, and we'll have to see how that plays out. But so altogether, we're seeing some good things happen. We have one other kind of seasonal piece that usually pushes the market up, and that is midterm election year. And so if you look back over the last 70 years at all the midterm elections, and you look at the pattern, it generally bottoms out around the middle of October, and lo and behold, so far this year, we're kind of bottoming out on October 12th, so pretty close. And then we have a rally that comes through the end of the year, right, and kind of pushes things up. Got earnings season plus that seasonality of the midterm election are kind of the parts that might move it forward. I guess the biggest difference to me, though, is that, if you look back at that 70-year history of midterm elections and look at that pattern, how's it going to react in a situation where you have a pandemic that's affecting China, a war in Ukraine, and a high inflation rate, really around the world? That's hasn't been there in that 7-year data, set. So we'll see how that plays out and what has you. But We saw a pretty good run up today. We had the Federal Reserve interview with the Wall Street Journal, and a couple sources are saying that basically they maybe would do less rate increases in December, and that's a big deal right now because it's already kind of a foregone conclusion as far as the market's concerned that November 2nd, we're going to have this 3/4 point increase. Well, 75% chance that we're going to have a 3/4 increase in December as well. But after that article in today's Wall Street Journal, that dropped down to a 58% chance. So still a majority chance on a betting basis that we're going to have 3/4, but it's backing off a little and the market's coming up from that, right? So, we're seeing some good things and maybe we'll see some movement upwards. The problem is if you look closely at this chart, we've had so many strong movement upward. I just saw a little table today that showed, between 5 and 10% positive moves up. There's been 10 of them so far this year. Even though the market fell 25% in total, we still had 10 situations where the market was up kind of in that 5, 10+% range. You can see some of the big ones here, but there's lots of small ones. And so that's the problem. You can get a decent week like this week looks like it's going to be. You can have some good runs, but is it real? Does it really break out? Do we change the primary trend from down to up? And really, I think there has to be some other things in place before that happens. I think we can have a decent run right here, maybe even through the end of the year. But is it enough to draw us back into, a primary trend on the up? I think we need to see some other things. And a couple of things that I think are kind of weighing on the market is, first of all, this is the leading economic indicator put out by the Conference Board. The blue line there is the leading indicator. The gray line that's kind of underneath it is what they call the concurrent indicator, which just means that it's essentially the existing economy. And so those gray bars there are the big recessions. And so the first one over there is 2000, and that obviously was a big downturn, over 45%. And then the second one, of course, was 2008. Stock market dropped 57% there. And if you look, just got reported on Thursday, September was down again. Very definitive top. I mean, look at that, actually. It's better. It's a stronger top than what we saw in 2000 or 2008. And so that tends to lead these big economic downturns, which tends to lead these big downturns in the stock market. And so if you go back to 1960 when this started, it's got a pretty phenomenal track record of kind of leading these big economic downturns, which usually lead to big stock market downturns. So, but it can be early. Mm-hmm. Like if you look back to 2008 when it peaked there, it peaked about 12 months before the market started to really fall apart. So it can take a while for that to translate. But to me, we have these headwinds that are pushing things forward, like the seasonality of the midterms and the earnings season and all that type of stuff. But we also have some really, things that are kind of pulling us backwards too. And this would be one of the things. And this is reported once a month. It was just reported last week. So I consider this one of the key components to watch. It's one of the most important things as far as I'm concerned, just because it has such a good track record. But one thing that I've been doing the daily updates all week. I've been talking about the 2-year and the 10-year Treasury yield. So this is the 2-year Treasury yield, right? So this thing went from about 0.2% to now about 4.5%, really, in a 1-year period. And you can see how strong it is moving upward. This 2-year Treasury yield is very sensitive to the Federal Reserve. And so as you see this thing moving upward, it is projecting what the Federal Reserve might be doing. And so historically, when you go back to these higher inflationary periods, this will peak out at around the same time the stock market bottoms out, right? And so, but we need to see a peak out, right? I mean, there's nothing on here. The 200-day moving average is going straight up. It's that blue line. The yield is kind of got a few little peaks here and there, but pretty strongly up and not falling really at all. Falling a little bit today based on the Wall Street Journal article, rightfully so, just kind of readjusting in case there is less increase in rates than people thought. But the bond market is really good at kind of figuring out what's going on with the economy And it's one of the reasons why they talk about the inverted yield curve. And it's probably the number one predictor of economic, recessions that might be coming. And that's because the bond market's quite good at looking at what might happen to the economy in the future. So if we see this 2-year Treasury peaking out and starting to come down, that might be a point in time where we really start to believe a lot more in the run-up that might be happening at that point in time as a potential change into a primary trend up instead of primary trend down with just another fake move, right? So today we're up. This week we're up. Well, so is the 2-year Treasury. To me, that means it's a false move. If you look at this, we had that massive run up in the summer. We don't see a big breakdown here in the 2-year. So the 2-year was telling us that the summer rally was a fake move, right? And rightfully so, it was. So the 10-year Treasury is also worth watching. Although if you look closely at that big dip here, just kind of right over my head, that was the summer. So it did break down, and it signaled that maybe things would be doing better. But the 10-year is not as good at predicting what's happening, at least in this particular time period, because it seems like the 2-year is much more locked in on what's happening with the Fed. But these are two pieces that we'll be watching really closely, along with that leading economic indicator, to try to tell when we might see some type of a scenario where we have a peaking of the interest rates, signaling a potential drop in the Federal Reserve's rhetoric, maybe finally signaling a drop in 3/4 point increases, finally getting down to go in the opposite direction at some point in time. And all of this is kind of predicated on what's kind of normal and what have you. The one thing that could change everything we're talking about here quite quickly is something breaking, right? And that is a much higher probability here. Usually the things that break that we're not talking about are the ones that are the most damaging. And, there's lots of things we can talk about with Russia, Ukraine, Europe itself, emerging markets that are struggling, China, that's having problems, the dollar, which is driving up and up and up, causes potentially something to break, But I'll give you an example. I mean, one of the things that kind of really scared the market a few weeks ago was the fact that the UK came in with a new prime minister, going to cut taxes, going to increase debt. Of course, increasing debt right now is a trouble because it's really expensive. The rates have gone up tremendously. And that bond market started to kind of implode. And what we found out was that the UK pensions had a lot of leverage. That was a surprise, right? That's what I'm talking about. It's those things, again, that old saying that Greenspan had, who was a former Federal Reserve governor, when the tide goes out, you can see who's swimming naked, right? And it's exactly that. So when you put pressure on the whole system globally, we'll start to find out, wow, the UK's pension system is highly leveraged. It's like, that doesn't, wasn't something that we knew about. When Lehman failed, what we found out was that there was an awful lot of credit default swaps that were out there, more than was expected, and then those ended up having to be paid off, and everybody had to sell all their stocks to pay those off. But that wasn't what was expected at the time when they let Lehman go. Otherwise, the Treasury and the Federal Reserve might have bailed them out, like they did Bear Stearns just before that. So these are the things that that are out there right now. I'm hoping that we're already hitting a bottom. We're building this little base in the market, and we're going to kind of come up. But we really need to see some confirmation. Can't have the leading indicators going down every single month. Can't have the 10 and 2-year Treasuries going up substantially and expect that this particular run-up is going to be the end, right? We need to see some of those other things peel off and keel over before we can probably see a sustained run that will change this primary trend from down to up. So anyway, that's our outlook right now. Very interesting time frame as usual. Look forward to being able to cover this in a couple of weeks. I'll give you my summary, but let's get into the questions that we've got today. What's our first question?
In past shows, you've mentioned nibbling at the market. Gain small portions of the investments and back into the market. What signs are you looking for to nibble? Is this a fundamental sign or a technical sign?
Yeah, it depends on what you call fundamental. For me, fundamental is overall market fundamentals. And I would include the Treasury yields in that personally. And so, would love to see the 2-year Treasury start to, keel over. That would be a strong nibbling standpoint. The inverted yield curve kind of correcting itself would probably happen at the same time. But in essence, watching what's happening in the bond market as a key indicator for what you might do in the stock market. And then obviously, we're looking at a scenario where potentially something really falls a lot. The S&P 500 comes down, and I use a stretch index, and so you get that big stretch. I would nibble at that. I would buy that stretch at this point in time to the downside. We haven't had that, right? We've been, we haven't had it recently anyway. So the technical pieces, we have a lot of different indicators, moving average crossovers and trend lines, a whole bunch of ATR trailing stops, Bollinger Bands, a whole bunch of different pieces that we look at. And so as each one of those kind of triggers, we would probably take some action on that and just kind of slowly but surely moving back in. And one of our biggest triggers is a moving average crossover, which seems to have worked pretty well so far this year. We're not that close to that right now. We are kind of close to some of the earlier indicators, like the Fisher transform indicator, which moves quite early and quite often, has actually turned positive this week, for example. We've had a couple of Bollinger Band breakouts. For example, we have that on Apple right now, but no other confirming, evidence that we're coming out of this. But, those are the types of things we look at. So both fundamental and technical. I would probably be really reluctant to go fully back into the market if the 2-year Treasury was still going straight up like it is now. I can't see that working because the bond market and the stock market are disagreeing with each other, and the bond market often is right, especially in these type of environments. So, yeah, it's a good question.
So what are your thoughts on immediate single premium annuities?
All right, so immediate single premium annuity was where you would go to an insurance company, whoever that might be. You would give them a lump sum of money, and they would give you a payment for that lump sum. And the payment terms are really varied, actually. You can do, just your life, or you and your spouse, joint life. So it'll keep paying, until the second one of you passes away. You can do what's called a term certain, where it pays for your life if you live, 20 years, but it'll at least pay 10 no matter what. If you die a year after you give them your lump sum, it'll pay out for 10 years. So your beneficiaries, at least get a nice return from that. And so the whole bunch of options, every one of those pays a different amount. The more certain the term is, the less you're going to get. So life only with kind of no other criteria pays the most, usually. And that can actually pay pretty high yields if you look at it and do the math to figure out what you might get out of that. The more the interest rates go up, the more you would get. So, that's becoming more advantageous. But the nicest thing probably about a single premium annuity is that you're now going to get, a guaranteed income source from that insurance company for whatever period you chose, or for life, or what have you. It's like a pension, and pensions can be really powerful. We got our Social Security coming in. Now we don't have many pensions, so maybe you take some of your money and buy a pension. And generally speaking, if you buy stocks and bonds over the long term, you're probably going to beat out that annuity. But you do go through these really nasty periods like we're going through now with the stock and bond market. And so that's where that annuity would still be paying out and paying out and paying out. I do think if you're going to do this, it should be, a smallish percentage of your overall net worth. And it has to be enough, money to still make difference, right? So if you have $100,000 net worth, I don't know that you want to do a single premium annuity with $5,000. It's probably too much of a hassle. If you've got $1 million, $10 million, whatever that is, then maybe you have enough money to make it worthwhile as far as that goes too. But yeah, they can work. Now, the biggest disadvantage, of course, is that whatever money you give to the insurance company is now gone, right? So that liquidity is gone. So you got to make sure you have other liquidity someplace. You don't want to give them all your liquidity. And so, again, that's why you kind of look at a smaller percentage because it's gone. You're just going to get that payment for life, joint life, term, whatever it might be that you've chosen as far as that goes. So I think they're interesting. Having said that, I actually haven't seen really, I can't even think of one situation where somebody did it. And I know they're out there and they do them. But I have no problem with doing them. I think that's an interesting concept. For me personally, I have sat across the table from retirees for the last 36 years, and I will say people that have large pensions have the happy retirement. You know, they're not having to live off the stock and bond market. And a lot of teachers, you know, for example, they got a nice pension and what have you, and they're really, you know, maybe even not even touching their assets because they have all these pensions, money, and Social Security possibly coming in. And that has now kind of dissipated down to just certain industries and certain, you know, careers. And so this would be a way to do that. And I would look to do that myself, depending on the structure of what I end up with in my retirement, just because I've seen how happy it makes everybody, and just trying to take a piece of the action off the table from the stock and bond market. Because, I don't know, the next Great Depression, you know, you might be happy to get that cash flow, assuming that insurance company survives, right? There is that aspect, right? You're at the whims of that company's strength. My understanding is that annuities have done really well. Even if a company fails, oftentimes the industry steps in.
Yeah, they'll bail each other out.
Bail each other out, just because it's such a bad, you know, marketing aspect to have a failure there. But there are great companies, you know, the New Yorks, the MetLifes, you know, Nationwides of the world, that probably have less chance of going out of business, you know. And so you can look at their ratings and try to buy some of those high ratings. You're going to get less return for that rating, but probably worth it if you're really looking for the safety aspect. So
yeah, it's great peace of mind. And sometimes, but with a lot of annuities, these payments don't go up, so there's no inflation protection. So this is kind of just saying that base standard of living. You know, every month you gain this X amount of money, and so that's good for the rest of your life. But it's not going to adjust as as things get more expensive. Your buying power is going to go down with it.
Yeah, and that's specific to the single premium, you know, immediate annuity too. That, you know, there's variable annuities. There's a lot of annuities. There's a whole host, but it's basically a pension if you look at it that way. And because a lot of pensions don't go up much either. Some do, which is kind of nice, but a lot of them are kind of fixed, and so your buying power does erode. But again, if you just have a smallish percentage in that, your other monies could be in that stock and bond market to kind of be able to grow, to offset the erosion of buying power from that pension. And at least you have some, like you say, a base level there, which could really be nice. Yeah.
Yeah, that diversification is powerful.
Yeah. I think it's very interesting to look at it.
What's probate, and why is it so bad, or why we've heard so many horror stories about it?
Yeah, so this is a question we get. We're not lawyers, right? But we get a lot of tax questions and lawyer questions. I guess because we don't charge by the hour. So hoping to get an answer. But so you have to be a little bit careful there. But we have experience in watching what happens. I have clients right now going through probate, right, and watching this go on. And I've watched this for 36 years. It seems pretty painful. You know, the one that I'm working on right now is quite substantial in size, and it's been going on for over 2 years, right? I don't know what the average is, but it's got to be over a year to settle.
Yeah, it takes a while.
It takes a while. You have to go through the court system, and we just looked it up before the show because we got this question during the week, but it was $184,000, I think $500.
Yeah,
was the amount that if you're over that, you go through probate, or your estate goes through probate. Obviously, you've passed away, but your beneficiaries are dealing with this. And if you're under that, then it still does go straight without the probate, which is fine. But that's why the living trusts are kind of popular. There's some other ways around that, and different, you know, ways to handle that with transfer on death accounts, and living trusts, of course, are, you know, expensive. So there's some other ways to take a look at that too. But just straight up passing away without any of those things, you can end up with this, you know, fairly large amount of money that ends up going through probate. And, you know, then you have an attorney cost to get through that, which can eat into your estate. And so you're not doing your beneficiaries much favor by having to drag all of your assets through probate. So And that would be something really nice to do for your beneficiaries, just to make sure that you don't go through probate, as if at all possible.
Yeah, and probate is public information, so anyone and everyone can look at it. So you're basically airing all your information to the rest of the world.
Yeah.
It's if your neighbor down the street could look you up and say, "Oh, this is how much money they had in probate," and figure that out.
Yeah, I read an article once about the genesis of that. It used to be that they posted it like outside the courthouse, like on this big wall, and because creditors could come by and say, okay, that's what's out there, and maybe they weren't going to be taken care of without that knowledge, and so that's one of the reasons it's public. So obviously that's not something that probably happens as much anymore, but it's kind of interesting to have all your stuff hanging out there. Bound to get some calls and emails and different things that you probably don't want either, from people that maybe you don't want to talk to. So again, that's where a living trust, for example, is private. The settlements that we see on living trusts are more like 60 days. I mean, you get the death certificate and it goes pretty quickly. It's describing who gets what, and everything goes fairly fast. They're kind of a pain long term to have and redo. I'm redoing mine right now, but for beneficiaries, it's a really nice thing.
Yeah, but the thing is, like doing a will or a living trust, all that money that you do now that you have to pay now, you save that later on in attorney fees and just that headache for your beneficiaries. So it's like you pay it now, you don't have to worry about it later, kind of thing.
Right. Yeah, that's right. Somebody's going to pay it. So sometimes people just say, oh, whatever, it's more than I got, and whatever they have to do is fine. And that's okay too. It's all about philosophy, but just so you understand how it works, because sometimes people don't understand how it works, and they're, a little shocked to find out that, oh, I'm going to create all these problems, and they want to fix that, right? So it depends on your relationship with your beneficiaries and what have you. All right, what else do we have?
I have some extra cash that I want to put into a certificate of deposit. What length should I be looking for?
Yeah, this was a question that came in from a client this week, and we started to dig into it, and it's kind of interesting. My first thought is you want to go very short term because rates are going up, up and up and up. And so one of the things that happens is that, if you get say a 3-month CD, then it comes due, you can roll that over into something, again, if rates are still looking like they're going to go up, maybe you stay short term until they look like maybe they're peaking, and then you would maybe go longer term, a year, 2 years, 5 years, whatever it is, depends on what that money means to you and when you might need it. But one of the things we found when we look into that was that the very short-term CDs are not paying much at all, at least at the banks that we were looking at. The credit unions are better, and they're definitely better. But this particular situation, you kind of wanted to stay at his existing bank, which is one of the big banks, and so they weren't paying much, which is kind of ironic because we just looked up today, getting ready for this question, the T-bill right now, the 3-month T-bill is at almost 4%.
Yep.
So if you're going to get a 3-month CD and the bank can go put that into a T-bill at 4% and they're paying you 0.9 or something, there's pretty good margins there. The banks are making some money there. I thought that was kind of interesting. But we did find in this particular case kind of a 7-month special offer, and that fits to, I think, 3 to 6 months. Comes due, you can look at something else, right? And try to find a different term or different special offer as far as that goes.
Yeah, and you can hunt along for what, the best CDs are. Another option is money market, if that, but usually it's going to be those online banks or those credit unions that pay the best rates. Your Wells Fargo's, your Bank of America's, they're not going to give you really good rates unless they have a promotional rate. A lot of those promotional rates are for that initial term, you'll have that great rate. But then at that renewal, you'll go back to that standard rate, and then they'll automatically renew too. So that's how they kind of catch you.
Yeah, they're working on inertia there, right? I mean, they do 1,000 of those, and 500 of them stay, because people don't have the time to go move it and deal with it, and then they lower your rate, and that's how they make their money. So you have to be active on that. I actually really like the money market funds right now as an option to a CD. you don't have the FDIC insurance. So you got to be careful there. It depends on how much money it is, how much that money is to you, and those type of things. But we were just looking up the Schwab money markets, and they're kind of in that 2.7% to 3% range, and they all have a $1 share price. There's some risk there that could change, but usually not. And the one advantage of a money market is as rates go up, they'll start to go up right away. So you don't have to wait for 3 months or 6 months or 7 months to roll it over into something else. It just keeps going up and up and up. And they're paying more than those big banks. They don't have that FDIC insurance, and they've got a bit more of an efficient, system to do that. But that's something to look at too, is kind of these money market funds at these big institutions, the Vanguards of the world, and those types of things that I think are, going to be a pretty good place right now. Because those same money markets were paying about 0.1, 0.2%, a year ago, and now they're paying, 3-ish. That's not bad, right?
So this question came in. What's the difference between a money market account and a money market fund?
Oh, that's good timing. So, money market account is generally considered a money market at a bank, right? Pays less, but has FDIC insurance. So that's good, up to $250,000, and I'm not familiar with all the rules of how that works, so you have to make sure you understand that. But a money market fund is actually you go out to a place like Schwab or Fidelity or Franklin or Vanguard, or et cetera, and they have a money market fund, no FDIC insurance, but similar concept in the sense that it's still a $1 share price that doesn't change. I will say in 2008, we saw some money markets, and it was a big deal at the time. It was big news. Some money markets dropped to like 96 cents a share instead of $1. And these were mostly high yield money markets, so you do have to be a little bit careful there. But what they're doing is they're buying very short-term, investment instruments, and passing along a fair majority of that yield to you. And that's why when we looked up the Schwab pieces today, it was like 2.7 to 3% on their different money markets, depending on which type you wanted and how much money you had, and that kind of things for the minimum investment. But which is a pretty decent return in today's market. Whereas that money market account at the bank, you might find that that's closer to 1%.
Yeah, and some of those online banks you can get up to 2.5%, so they're not bad either.
Yeah.
But one thing to be concerned about with money market fund ones is you have to actually renew or redeem those shares. You have to sell that share. With a money market account, you could just go and say, I need $5,000 and get it instantly, essentially.
Yeah, that's right.
So there's a little bit of step through that. And the funds also have different security backing. So you could get a treasury backed one versus, something that's just a general prime market one.
Right.
And so they'll have varying rates depending on what kind of security are in generating those returns. Yeah,
generally the higher security, the lower the fee. So in that range of you might get 2.7%, and if you went with a generic one, you might get closer to 3, right? 2.8, that type of thing.
Yeah,
so.
There's always a little bit more risk you take on, a little bit more return you'll get paid.
Right. But I think it's a pretty interesting area to look at in this environment. Again, the interest rates are going up. Pretty much, we showed you the chart for the 2-year and the 10-year chart earlier. They're going up, pretty much every day. The 3-month Treasury bill is going up, and so the money market has that ability to move kind of even day by day upward instead of locking into a CD or something along those lines. So I think it's a valid thing to look at. Just got to be aware of the risks.
This question came up during one of your client meetings this week. How do I teach my children the value of savings?
Yeah, I had a really good conversation with a client, trying to dig in on, what they can do to help their children be better with their money, right? And wanted some advice on things that I had, done, or things that I had seen with other clients and what have you. And I'll tell you the first thing that I told them was just, I got into this business kind of very curious about how money works and how you create wealth and how you invest, right? And so I'm constantly asking clients that have done really well, what was it? What did you do? What was the thing that kind of propelled you to do this? And so first of all, the number one criteria within my clientele for how they got to be, millionaires in essence, is that they are savers, right? So they save. And the number one comment they say about that is very, very similar, and it is, my parents told me to pay myself first.
Mm-hmm.
So when I'm talking to this client about their child, we were talking about all kinds of different things and different ideas and thoughts and little pieces. But I kept going back to that same thing because here I am talking to, say, a 70-year-old or a 75-year-old, and one after another they're saying kind of the same thing. My parents told me to pay myself first. And of all the things that they learned from their parents and learned from their life, that's the one that stuck.
Mm-hmm.
And here they are sitting there with a very nice retirement, and they've got this money, and they basically have that one comment. It's like, so I would start there and really focus on that. And then maybe you don't have to go any farther. Maybe there's nothing else to it. Just get your kids to understand to pay themselves first.
Mm-hmm.
And so a certain percentage of their pay goes into savings, and then you live off the rest, right? That was the same, that's the comment I heard. Put this away and live off the rest. And your lifestyle should be based on the rest, but you always have the savings going in. The amount of savings is, 5 to 25%, depends on situation and person and how much discipline somebody has. But that's number one, if you really want to help your children, is at least from my experience of dealing. That's the one thing that's neat about our situation. We can go all the way down the path. We can talk to a 75-year-old,
Mm-hmm.
look back down their life and say, wow, this is what they did. This is how they did it. And usually people are thinking, oh, well, it's about investing. It's about, these great rates of return or finding this great stock or, buying this real estate. And I have seen people that have accumulated really nice net worths, and their investing philosophy has been far from ideal.
Mm-hmm.
Not really great. Now, those people that have ideal investing philosophies combined with, a good savings rate, they're 10, 20 million. Yeah, that's the big ones. But it really starts with savings, because it goes the other way. If you're a great investor and you don't have any money, you can't do anything. And you got $1,000 and you make 100%. Now you have $2,000. It's still, I'd rather make 10% on $1 million, right? So it's not about the returns per se. That's an add-on. That's a secondary thing. You have to be able to save the money and accumulate the money, right, in some form or fashion. And then obviously you want to look at stocks and real estate and those types of things, because those are good wealth generators from that, right? And so I think that's the beginning portion of trying to help your kids get better with their money, is get them to understand that pay themselves first. I can't tell you how many times I've heard that from my clients. It's amazing. It's really stuck with me.
Yeah, and sometimes, when they're younger, and you can always do a little matching. Say, hey, every dollar you sent, say, we'll match $1, kind of like a 401k match in a sense.
Yep.
To incentivize that matching, and that's a very common thing that we see in our practice with young adults or kids in high school with their first jobs.
Yeah, exactly right. That's I'm talking to these clients. We were talking about the possibility of having their son was just making some money, set up a Roth IRA. And so, you can put $6,000 into a Roth IRA if you earn under a certain amount, right?
Mm-hmm.
And he was going to, it looked like. And so, we're talking about maybe matching, dollar for dollar. So if he got up to 3,000, they would be putting in 3,000, and that's 6,000 going into his Roth. And, I did a quick calculation on a 50-year $6,000 contribution. This kid was 18, so
Mm-hmm.
for at 11% return, which is the average stock market return, and it came out to a little over $10 million. Which is a lot of money in today's dollars. Wouldn't be as much in the future, but still kind of amazing to have that amount of money, sitting there growing tax free, right? So
Yeah, because that's $300,000 that turned into $10 million.
yeah, that's a decent deal. So anyway, that's the power of starting young. So that was the other thing that I told them, was that the matching portion, like you said, and then we talked about that whole, just the concept of understanding what it could do for you. Hey, you got to put $3,000 in. I'll put 3,000. That's good. It was pay yourself first. Okay, that's important. But look, this could be $10 million. Hey, that's that. So the making that motivational piece in there also, because it seems like you need, at least from what I've seen within my clients, and again, this is more of a secondary besides pay yourself first, but you kind of have to think money's important. And not everybody does, and feel like it's somewhat of a limited commodity. Like a lot of the people that struggle with saving always feel like they're going to have more in the future. And the people that are, the great savers are the ones that are worried about having enough money for the future. It's a subtle difference, but a big difference. And so, kind of getting that philosophy ingrained, because we don't know for sure what type of income we're going to have in the future. We might have a great outlook on where we're going and great degrees and a great career, but things can happen. So having that saving, mentality has been very effective for the clients. So if you look at a very successful 60, 70, 80-year-old client, and you go back to an 18, 20-year-old, 25-year-old, child who's now starting to make money, that's where you can look at that path that got those people to success and just recommend the same things that they did, right? And, we're not experts on this. It's just what we've seen within our clientele. Again, by looking backwards in our clients' lives and asking questions about how they got there.
Yeah, let's see if we can squeeze in one last question.
Sure.
I keep hearing the importance of long-term capital gains. Why is it so important?
Well, there's two types of capital gain, and a capital gain is when you sell something at a gain. So that could be a stock, it could be a bond, there's even collectibles, which we won't get into, but if we just look at kind of the stock market and real estate, are the two big ones, right? So your home maybe, or your rental properties, or your stock portfolio. And so those things that you do not have in a retirement account, right? They're not in a 401k, not in an IRA, not in a 403b, they're in what we call a taxable account. When you sell them at a gain, there's two gains. There's short-term gain and there's a long-term gain, right? So short-term gain is under a 1-year hold. So if I bought it this month and sold it next month and I had a gain, that's a short-term gain. Sometimes you might want to do that just because you might turn into a loss if you hold on to it for too much longer. But generally speaking, if you can hold on to it for a year, the long-term gain is a lot less. And so the long-term gain brackets are 0, 10, 15, and 20, right? And so if
I think it's 0, 15, and 20.
That's right, 0, 15, 20. And so essentially the same bracket that you'd be in on ordinary income, which is how they tax a short-term gain. So if I take a short-term gain, it's just considered ordinary income. The tax bracket's higher for the same dollar amounts. And so I might spend 22% on something that I would only spend 15% in tax on that capital gain, long-term capital gain. So short-term is just ordinary income. You look at the ordinary income tax rates, gets added in there with the rest of your income. And long-term capital gains are a special tax bracket, basically, specifically for that. So they're obviously better. And that's what we always strive for is long-term gains, and that can really help. It's still kind of hard to pay them taxes one way or another, but
yeah, that's how all those hedge funds managers and stuff like that have such low tax brackets. That's how Warren Buffett pays less money on taxes than his secretary.
yeah, because his income is all gain, capital gain, which is can be a lot less. Exactly right. So. All right, well, that's our show for today. I want to thank everybody coming again. I'll remind you that we will not be here next week. Unfortunately, we are taking vacation, and we won't have the daily videos next week either, but we will be back the week after that. I think the first daily video that I'll do again will be on Halloween, Monday the 31st. And so again, feel free to send in questions, though. Give us a chance to work on them, even while we're gone. We'll get them together when we get back, and you can send that to Ask Tom at talkmoneywithtom.com, and happy to answer those. So you can see what we're doing here is just trying to educate you. You can subscribe to the channel and hit the little bell button, so when we do put new content on, you can get notified. Watch these, learn from what we're learning from our clients and how that's working, and then of course you can always schedule a time to meet with us. Right, you go to the calendar, hit the book appointment button. Our calendar's live, and you can pick a 30-minute time with Ethan and I to ask us specifically questions for yourself. So great show today. Thank you so much for the questions. Love the chance to be able to answer these on this live show. Look forward to seeing you in a couple weeks. Thank you.